Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Buyout funds are one of private equity's most powerful tools for transforming companies, and they're attracting more investor capital than ever. These funds use a mix of debt and equity to buy controlling stakes in businesses, aiming to improve operations and sell them for a profit. Whether you're an investor or just curious about how buyout funds work, this video breaks down the mechanics, rewards, and risks. No jargon, just clear insights. Let's get into how they operate and why they're a go-to for serious returns. What are buyout funds? Buyout funds are specialized investment vehicles under the private equity umbrella. Their goal: to acquire controlling stakes in companies, restructure them, and sell them later at a profit. Unlike mutual funds or ETFs, buyout funds pool capital from institutional investors like pension funds or endowments and high net worth individuals. The fund manager, known as the general partner, GP, uses this capital, plus borrowed money, to buy businesses outright. These funds target undervalued or underperforming companies with strong potential for improvement. Once acquired, the GP works closely with management to streamline operations, cut inefficiencies, and boost growth. The end game is an exit, either through a sale to another company, an IPO, or a recapitalization. Some of the biggest names in buyout funds include Blackstone, KKR, and Carlyle Group. For example, Blackstone's acquisition of Hilton Hotels in 2007 turned into one of the most profitable buyouts ever after restructuring and a later IPO. Types of buyout funds. Not all buyout funds operate the same way. The strategy depends on the deal structure and the parties involved. Here are the most common types. Leveraged buyouts, LBOs. This is the classic model. The fund uses a small amount of equity and a large amount of debt to buy a company. The acquired company's cash flows typically repay the debt over time. LBOs often target mature businesses with steady revenue. Management buyouts, MBOs. Here, the existing leadership team partners with a private equity firm to buy out the company. MBOs work well when management knows the business inside out and can drive rapid improvements. Secondary buyouts. A private equity firm sells a portfolio company to another buyout fund. This happens when the first fund has already extracted most of the easy gains and wants to cash out. Distressed buyouts. These target struggling companies in need of a turnaround. The fund buys the business at a steep discount, often through bankruptcy proceedings, and restructures it for survival and growth. Each type has its own risk-reward profile. LBOs rely on debt, making them sensitive to interest rates. MBOs depend heavily on the management team's skill. Knowing which strategy a fund uses helps investors gauge the potential upside and risks. Key players in buyout funds. A buyout fund doesn't operate in a vacuum. It relies on a network of participants, each with a distinct role. Limited partners, LPs. These are the investors. Pension funds, endowments, insurance companies, or wealthy individuals. They provide the capital but stay hands-off in daily operations. General partners, GPs. The fund managers who make investment decisions. They earn management fees, usually 2% of assets, and a performance fee, typically 20% of profits. Portfolio companies. The businesses bought by the fund. The GP works closely with their leadership to execute growth plans, cut costs, or expand into new markets. The success of a buyout depends on how well these players collaborate. LPs need trust in the GP's strategy. GPs must pick the right companies and manage them effectively. Portfolio companies, meanwhile, must adapt quickly to changes under new ownership. How buyout funds generate returns. Buyout funds don't just buy companies and hope for the best. They actively engineer higher returns through smart financial moves, operational tweaks, and well-timed exits. The magic happens when they combine leverage, operational improvements, and strategic exits to turn undervalued businesses into profitable investments. Let's break down two key drivers of their success. The role of leverage. Debt isn't just a tool, it's the fuel that powers buyout returns. By borrowing money to fund an acquisition, buyout funds put less of their own cash up front, which means even modest gains get magnified. Here's how it works. Small equity, big impact. If a fund invests $50 million of its own money and borrows $200 million to buy a company, even a slight increase in the company's value translates into a much higher return on the fund's original stake. Debt service as a discipline. The pressure to meet loan payments forces management to cut waste and focus on cash flow. Look at Burger King's buyout by 3G Capital. Aggressive cost-cutting and efficiency drives boosted profits post-acquisition. Risks to watch. High leverage can backfire if cash flow dips or interest rates spike. Toys R Us collapsed under its debt load after a 2005 buyout, proving that leverage is powerful but dangerous. Smart buyout funds balance debt carefully, ensuring the company can handle repayments even in downturns. Exit strategies. Holding a company forever isn't the plan. Buyout funds aim for a profitable exit, usually within 3 to 7 years. Picking the right moment and method makes all the difference. Common exit routes include IPO. Taking a company public can unlock massive value if market conditions are right. Hilton's 2013 IPO turned Blackstone's $6 billion investment into a $14 billion payout. Trade sale. Selling to a larger competitor or strategic buyer, like Microsoft buying LinkedIn, often fetches top dollar, especially if the acquirer sees synergies. Secondary buyout. Passing the company to another private equity firm works when there's still growth potential. Think of Skype's journey, sold from eBay to Silver Lake, then to Microsoft. Exit timing depends on market trends, the company's growth stage, and investor appetite. The best funds don't just wait, they shape the company's story to match the ideal exit window. Benefits of investing in buyout funds. Buyout funds offer unique advantages that set them apart from traditional investments. They combine high growth potential with active management, giving investors access to opportunities rarely available in public markets. Let's explore why they attract capital from pension funds, endowments, and high net worth individuals. Historical performance metrics. Buyout funds have consistently outperformed public markets over the long term. While past performance doesn't guarantee future results, the numbers tell a compelling story. Average annual returns. Top-tier buyout funds have delivered net IRRs, internal rate of return, between 15% and 25% over the last 2 decades. That's roughly double the S&P 500's average return of 10% during the same period. Outperformance consistency. According to Cambridge Associates, buyout funds have beaten public equities in 80% of 10-year rolling periods since 1986. Low volatility. Unlike stocks, buyout returns aren't tied to daily market swings. This smoother performance curve appeals to investors avoiding short-term turbulence. The best funds don't just ride market cycles. They create value by overhauling operations, improving margins, and timing exits strategically. For example, KKR's 1989 buyout of RJR Nabisco, while famously rocky, eventually generated a 3x return after restructuring costs. Portfolio diversification. Buyout funds add diversity because they don't move in lockstep with stocks or bonds. Their returns come from operational improvements and deal structures, not market sentiment. Here's how they balance a portfolio. Low correlation. Private equity returns have shown a correlation of just 0.3 to public equities, meaning they often zig when markets zag. Exposure to different sectors. Buyout funds target industries like healthcare, manufacturing, and tech that may be underrepresented in a typical stock portfolio. Tangible business influence. Unlike passive index funds, buyout investors actively shape companies, turning laggards into leaders. This diversification is especially valuable during downturns. Firms like Apollo thrive by acquiring distressed assets at discounts, something public market investors can't easily replicate. That's the core of how buyout funds operate. Stay tuned for part 2, where we'll cover the risks and why investors are drawn to them. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.